Hey everyone, Michael here bringing you a brand new video. This one is going to be related to the previous video that I recorded on how to get started in stocks. This one is going to be about the power of dividends and drips. So guys, talking about kind of just recapping on what we talked about before, I recommended ETFs. I also recommended if you wanted to buy individual stocks that you definitely buy stocks in sectors that you know, not ones that you don't know because you won't know how that company makes money. But in this video, I'm going to talk about individual stocks that pay dividends and what that means going forward and how you can use those to turn an investment into a major profit. So let's take a stock that's been around for a long time that pays a big dividend, and let's talk about how that can be used in your investment strategy. So AT&T is a company that has been around for a long time. Is a telecommunications company. They have other ways that they make money, but basically it's a communications company. And with that kind of company, there is limited growth and where they can expand to. The world is, a finite size. So that company can only expand through different markets than what they're at now. They can only grow in their certain business so large, but they make consistent income and they make consistent cash. So where that goes into play, that company can distribute what are called dividends to the shareholders. Dividends are usually paid quarterly. So there's a quarterly amount that they pay, 4 times a year, right? And then that gives you an annual dividend amount, those 4 added up, and then that divided by the cost of the share price gives you your dividend yield. So AT&T is notorious for having a large dividend yield. There are some stocks that pay less than 1% a year. There are mostly stocks that pay dividends are probably in the 1 to 2% range. AT&T has on average paid about 4 to 6% of its stock price in dividends, which gives it that yield. So a great dividend yield, the stock principal or the amount that you would have if you own shares of that stock does not grow as much, but that dividend payment that comes out every quarter is huge and a great way to make money, and safer money, I would say, than some of the other high-risk speculative stocks. So you guys heard me mention the term DRIP in the beginning of the video. A DRIP is what's known as a dividend reinvestment plan, and that is a really, really good way to make consistent income from those high dividend paying stocks. So here is the example of AT&T. Let's say you own 100 shares of AT&T, okay? And you don't add any more money into the stock, you just let that sit, and you have those 100 shares enrolled in a DRIP, or a dividend reinvestment plan, whenever a dividend is paid out. So let's just use an easy example that maybe the quarterly dividend is equal to 1 share of value of that company. So I own 100 shares of AT&T, that quarterly dividend comes out, the dollar value of that is equal to 1 share of the stock. So when I have those 100 shares and that dividend gets paid out, my broker automatically purchases that extra share of AT&T and then puts that in my account. So now I own 101 shares. The next quarter, since I have 101, it's going to be slightly more than 1 share. And with dividend reinvestment plans, you get fractional shares. So just to make the math even easier, I'm not using exact math, let's just say it's 102.1 shares I now own. Okay? And then the next quarter it'd be 103.4. The math isn't exact, but the idea is the same, guys. So you start to notice that your stock portfolio within AT&T snowballs. So the more dividends you're paid out, the more shares you're purchasing with those dividends, and then every time you own more shares, you get more in dividends the next quarter and the next quarter, and that pattern continues and continues. And one of the things I also talked about in my previous video where this really comes into play is price averaging. A DRIP is essentially a great way to price average a stock throughout time. So since you're purchasing more and more shares every quarter through that DRIP, you're actually price averaging the stock. And so I just wanted to share that with you guys today. Dividends are very powerful. Steer clear of dividends that do not have a long history of remaining solid and stable. If there are companies such as GE currently, which cut their dividend, that is going to have a huge negative effect on the share price as well as your dividend payouts. There are also companies that lose money or are starting to lose money that pay out high dividends to attract investors. I think GameStop is actually a great example of one now as well. They're paying out a high dividend yield to attract investors into their stock. That is not necessarily a stable dividend, but if you find companies like Coke or AT&T that have paid big dividends for many decades and years to come, those are the ones that are solid and safe to stay in. But just remember, with any stock investing, there is always risk, so you always want to have some diversification when you're investing in your stocks. So that's the power of dividends, guys. I'm a huge proponent of dividends. You can use it as a buy and hold strategy, and with the drip, you can take your investment to the next level. All right, guys, like, comment, subscribe. Let me know what you want to see on this channel, and I'll see you in the next video.